Hello, everyone. This is Tom Fox, and I would like to welcome you to episode 88 of the FCPA Compliance and Ethics Report. In this episode, I continue my exploration of internal controls with noted internal controls expert Henry Mixon. This is part one of a two-part episode on effective controls for internal controls for third parties. I hope you enjoy the episode. Thank you very much, and come back for part two.
Hello, everyone. This is Tom Fox, and I would like to welcome you to this episode of the FCPA Compliance and Ethics Report. I'm really pleased to have back my good friend and colleague, Henry Mixon. Henry and I are going to continue a series on internal controls and how they relate to best practices and our corruption compliance program. Last week, we did a two-part episode on what are internal controls, and I've asked Henry if we could maybe go into a deep dive on some of the specific internal controls that a company would need in their best practices compliance program. For those of you who don't know Henry, he is a well-seasoned and well-rounded veteran of both public accounting, private accounting. He has worked in corporate America. He has worked for a Big Four accounting firm as a partner. He's worked in internal controls and accounting in I believe, Transco. He has implemented the original COSO framework of internal controls. Henry and I met when my last corporate job, I was at a company that was under a deferred prosecution agreement for FCPA violations, and Henry was part of our initial implementation team that came in and helped us set up our internal controls. So he's got a wide range of experience, extremely useful, has worked with, as I did, with the government sitting over our shoulder in the form of a corporate monitor, looking at everything we did. So we had some comfort that the things that were approved to put in place would really constitute what the government and the Department of Justice wanted to see with a best practices compliance program. So Henry, with that rather long introduction, I'd like to welcome you back. And I understand that you're having a little bit of weather there in Houston today, so hopefully everything will work out for our recording. Henry, I've asked if you might be able to give us some thoughts and guidance on internal controls dealing with third parties. And the reason I've selected third parties to start with is they are generally recognized as highest risk for any company doing business outside of the United States. I think anecdotally the numbers suggest that between 95 and 90% of all FCPA cases involve third parties, and it can be anyone in the sales chain to your company, agents, resellers, distributors, sales agents, commission sales agents. They can be companies that come in through your supply chain, vendors, such as freight forwarders, lawyers, customs, brokers, visa processors, really anyone that your company would have a contractual relationship with. So with that really long-winded introduction, welcome and welcome back. And I look forward to hearing some of your thoughts on what we can put into a compliance program in the way of internal controls to help us manage the risk of third parties.
Okay, Tom, thanks a lot. It's a pleasure to be with you again today. I do have, as you will see as time goes on, a number of opinions about this particular topic, because not only is the use of third parties or intermediaries one of the highest risk areas, it's also one of the areas where standard gap controls are least likely to have effective preventive impact. And by the standard gap controls, I'm just referring to the normal internal controls a company has for generating financial statements without giving any special attention to the risk of FCPA. And as we've talked in the past, it is very easy to circumvent a company policy. You just ignore it. But it's very difficult to circumvent effective controls, and that's really the whole point of what I'd like to talk about. One thing that comes to mind in this area is, how can an individual in a company that supposedly has good internal controls get his hands on bags full of currency in large amounts to pay bribes? It is just intuitively not a likely outcome.
Henry, before you get into that, could I ask, you explained a little bit, identified gap as an important financial control. Why if a company is following GAAP, as most U.S. companies will, is that not sufficient for a FCPA compliance program?
Well, the thing, the primary reason is that the normal controls you have for generating financial statements have that as the objective, to generate accurate financial statements from the recorded data, the information that goes into the accounts. Those controls, by definition, are put in place to detect certain things so that accounting entries can be made to correct them. They are not controls that are put in place to prevent misbehavior unless somebody goes to take that extra step to put in preventive controls.
How does materiality affect GAAP as opposed to an FCPA internal control?
Well, in the world of GAAP controls, materiality is clearly a large factor, and that really is the case whether you're dealing with the controller's decision about how to record something or whether you're dealing with an independent auditor's approach to auditing the financial statements. Immaterial divisions, immaterial subsidiaries, immaterial transactions, however that is defined by the auditor or the controller, just don't get any attention. For example, in that Smith & Wesson enforcement action recently, they were starting an international division. They had no physical presence outside the U.S., and the revenues were not material. So in that particular circumstance, it's not really likely that normal GAAP controls have been put in place to deal with that activity just because of materiality. And that's generally the case with internal auditors as well. They have a finite set of resources, so they focus their attention on material areas as well. Now, the risk of FCPA violations is very material in most companies, but certain kinds of transactions can be deemed to be immaterial by their nature and therefore not get any attention. And yet, if you look at some of these recent enforcement actions, some of those amounts of bribes that were subject to those enforcement actions would clearly not be material to the company, but yet they found their way into the enforcement and the resulting fines and penalties.
You know, you started off by talking about, I think, what people would understand as an obvious bribe, cash or bags full of cash, suitcases full of cash, and there are a few enforcement actions where we've had that situation. But are there other less obvious forms of bribes?
Well, there's quite a number of them, and it's really a list that is only limited by the nature and extent of transactions that a company conducts outside the U.S. I can give you a few examples just because these are the ones that are the more common ones from enforcement actions and the more common ones from just occupational fraud generally, which, of course, corruption is just another form of occupational fraud. But, you know, bribes can be paid by employing relatives of government officials. They can be paid by making charitable contribution to favorite entities of government officials. They can be paid, as in the case of the HP enforcement, by giving laptops and other electronic devices. They can be paid by use of company equipment without any charge. They can be paid by leasing facilities from relatives of government officials at above market terms. They can be paid with excessive sales commission rates or discounts to distributors, which provide the funding for bribes. The list could just go on and on and on. And so I guess the issue facing most compliance professionals is, well, how do you decide what to do? And I think there's two basic areas that you focus on. One is it's not acceptable to do nothing, because if you don't take action, you're not mitigating risk. So that you look at what other companies have done or allegedly done wrong by looking at the kinds of bribes that were paid in enforcement actions, and you try to figure out, you know, could they occur in my company? But the number one thing is, just like I have been trained to do and gather from experience over the years of doing fraud investigations, you have to learn to think like a perpetrator. You have to learn to look at a situation and say, if I wanted to do something inappropriate, what could I do and how could I do it? And what is there in the company's controls that would prevent me from doing it?
If we could we drill down a little bit with a process that you might suggest that compliance practitioners use around the use of agents and risks associated with them to determine what type of controls are needed?
Sure. To me, anytime I face a challenge which just almost can be overwhelming, the first thing I want to try to do is get my arms around a universe of potential inclusion in that body of information. And so what I suggest is that the first thing that be done is prepare a profile which summarizes in one document all the relevant information about agents, which would show what kind of risk they pose and allow the compliance officer to draw trends and analysis of concentration of risk. It's basically the information that is probably in the due diligence files already, but by putting it in an organized document, it's a lot easier to see the patterns. And so once you have a profile and you see how you're doing business with agents in various locations, then you can say, now, what kind of transactions do we have with these agents? Are they marketing reps? Do they sell product? What do they do? And prioritize those transactions from the highest risk to the lowest. And then this is where a lot of people have a little bit of a problem, because generally in corporate America, no one wants to dictate a certain set of internal controls for an entire company. You know, I worked with a lot of companies that once you get to this part of the thing and you've prioritized the types of transactions, the response is, well, we were formed by acquiring lots of different companies, and we have all kinds of different systems, and so we can't go any further because we can't mandate a control that would fit every circumstance. And so that was exactly what we faced with the company you and I worked with previously. And so what we did in that circumstance is, from this list of transactions, we developed a list of control objectives which needed to be met at all business units at all locations. An example of a control objective would just be a statement that says, there will be controls in place to ensure that no vendors are added to the vendor master file until all required due diligence has been completed and the vendor has been approved. And so then each business unit or each entity takes that set of control objectives and design controls that fit their operations. I know we had at the client we worked on together, everything ranging from some business units that kept their records in little more than Excel spreadsheets to others that had sophisticated ERP systems like SAP. And so it's not a one-size-fits-all, but the objective can still be met. And then once you've developed objectives, then it's up to the business units to validate the control design and effectiveness and make sure those controls work. So it's, in my mind, it's very much a process, and that was the process that we followed on the client we've been referring to, and it worked very well. There were many other elements, but that was a company that was under a monitor, and it was more extreme than an ordinary situation where a company is just trying to do the right thing and get some good internal controls.
You spoke about the profile of an agent. Do you have some thoughts on what should go into that profile, what should be included in that profile, perhaps attributes you should consider? Any thoughts along that area?
Yeah, the profile itself will of course be driven by how a company uses intermediaries, but some typical things that would be in there would be the agent's compensation structure. Is it fixed? Is it variable? Are there bonuses paid? Are there success fees paid? Can the agent get advances of funds or loans? Is the agent reimbursed for expenses? Can the agent hire sub-agents? Can the agent get product samples for customer testing? Then the form of the compensation, is it U.S. dollars or some other currency? How the agent is paid could be a computer-generated check through the normal payable system at corporate, could be a locally issued check outside the U.S., could be a wire transfer. I've even seen some cases where agents were paid through local petty cash. Then the names and addresses of banks where the agent's payments are sent, any other payees that are associated with the agent, including sub-agents or any other third parties, the countries where the agent is authorized to do business, where can the agent market, where can the agent sell product. That should all be in the profile. And then for long-standing agents, I think it's important to have the names of customers currently associated with the agent, what we know about those customers. Are they government entities, or do they have known affiliations with certain entities that present risk? The scope of duties, what services does the agent really provide? Is it clear that the agent is really providing a service? The due diligence tier that's assigned and whether diligence has been completed. It's really only limited by how a given company has chosen to use intermediaries and what transactions are conducted and how those intermediaries are paid.
Henry, you've listed several areas that are outside or beyond the scope of anti-corruption and compliance. Can the internal controls you're suggesting help a company comply with a wide range of regulatory concerns? So, for instance, I heard you talk about wire transfer, and that obviously brings up money laundering issues. I heard you talk about location of payment. That may bring up export control or other regulatory concerns. Can these internal controls you're describing be used for a variety of regulatory requirements?
Well, that's exactly the key point. You're right on with that, and because what I'm proposing is not a set of unique controls for FCPA, even though they may be driven and identified initially by FCPA risk. The controls that go in place are good business controls that should be in a company that has those other regulatory concerns that you talk about, and not only regulatory, but it's pretty well publicized by the Association of Certified Fraud Examiners that on average, typical American businesses lose about 7% of annual revenues a year to just occupational fraud. And for example, one of the most common occupational frauds is fictitious vendors getting paid. Well, if you put in it controls over your vendor master file to keep fictitious vendors out, you mitigate your FCPA risk, but you also mitigate your fraud risk.
Once you've completed your profile of agents, some of the next steps you would suggest towards identifying the specific internal controls which may be needed?
Yeah, once you get a profile and you'll start to see a picture across the spectrum of agents, then I think the next step is to step back from the analysis and say, well, now we know the areas we should be concerned with. How does that translate into particular internal control areas? For example, if we know we have contracts with agents and they are high risk because of their commission rates or the countries they're doing business, then it becomes very important to focus on how approved agent contracts are correlated with the processing of invoices. If we know that we have agents that are paid by wire transfer, then it's important to focus on controls over wire transfers to make sure we have dual approvals and other things. And then it gets similarly as if we're concerned about diversion of funds, the effective diversion of funds as opposed to just paying somebody in cash or currency, then we say, well, do we need to look at controls over the approval of sales discounts to distributors? Receivable write-offs, where we could have a receivable that somebody writes off without proper approval, which in effect funds the agent to go out and possibly pay bribes. The controls over movement and disposal of inventory. Well, in the HP case, were there no controls that prevented someone from obtaining all those laptops and electronic devices? We don't know because we don't know all the facts. We know the allegation was there were no controls, and we know the result was the laptops and electronics went out. But, if we're in a situation where you have a product that an agent might be legitimately allowed to use for demonstration, you need to have controls to make sure that use doesn't go beyond the legitimate and turn into effectively an opportunity to pay a bribe.
One of the things that struck me about the HP case you mentioned was typically the bribery scheme involves some sort of overbilling rebate from the purchasing entity back to the U.S. seller, and then a kickback paid from that delta or that difference. At HP, we saw really the employees defrauding the company, not for personal gain, but to create a pot of money to pay bribes. And that's what, I've heard you talk about fraud against the company. You've mentioned it about the amount of loss estimated to U.S. corporations generally. It sounds like these types of controls really help prevent a wide range of fraud against the company, or am I just sort of missing something?
No, you're absolutely right. I mean, if one of the ways people can obtain funds to pay a bribe is to cause a wire transfer to be issued and turn it into currency, who's to say that person, if his or her goal was not paying a bribe, couldn't just do that same activity totally for personal benefit? And you raise a very good point, is that in terms of motivations, unlike fraud, which is motivated by a financial need that is unmet, many of these bribes are motivated by well-intentioned views that the company needs to expand its sales base, or by personal benefit views of, if I expand the sales base, I'll get a big bonus. But by and large, it's a slightly different spin than your typical fraud perpetrator who's trying to get money into his or her control to meet some other needs, not to give to a third party.
Henry, it looks like once again we have probably gone a little bit longer than I might have liked to really dive into this area. So what I might suggest we do is once again split this up into two parts. And so this will be part one, and then we'll come back on part two. But if I could end this part one, this episode, with the following question. You talked about the controls based on activities with agents, but are there some other areas where specific FCPA-related internal controls might be needed?
Well, there are several controls which apply to agent as well as preventing other misbehavior, and we'll talk about those in the next segment. The two primary ones are the structure and the enforcement of the delegation of authority and the maintenance of the vendor master file. Those are two control areas that aren't specifically driven by what any particular agent does or doesn't do, but they are overriding controls that, if you want to prevent payment of bribes, I think need to be at the very top of your list.
All right. Well, Henry, on that note, we'll end this session of the FCPA Compliance and Ethics Report. We'll come back in part two and really get into a deep dive on the delegation of authority and your maintenance of a vendor master file. I will certainly learn a lot, but I think more importantly, most compliance practitioners who are not auditors, accountants, CPA types will probably be enlightened as well. So with that, I'd like to thank you for this session, and I hope everyone will join us for part two of our deep dive into internal controls relating to third parties. Thanks a lot.
Thank you.